What is going on with our real estate market? If you're currently in the real estate market or you've been following rates and the federal fund rate, you'll know that last week, at the end of the week, we did see a significant increase in the average 30-year fixed mortgage rate. That being said, what I want to look at is why does the Fed make the decisions they do and what factors do they take into account? One of the major metrics that the Fed looks at is inflation. We all know about inflation by now. And right here, as you can see, the New York Times reported as of today, this is from figures yesterday released, that CPI on a monthly basis, inflation was rapid. It climbed 0.5% from December, up from the previous reading of 0.1%, owing in part to gas prices. So, of course, the Fed is looking at inflation and seeing that it climbed by half a percentage point month over month. And that is definitely involved in their decision making in regards where to take the Fed funds. The second major component that the Fed is looking at is the unemployment rate and the jobs report. As you can see here, USA Today has a headline, U.S. jobs report today. Economy added 517,000 jobs despite the recession risk, and unemployment fell to 3.4%. That's the lowest since 1969. So this combination of 0.5% increase in inflation month over month, plus the numbers looking so good on the job report, has resulted in what looks to be a little bit more of a hawkish Fed, meaning that we may end up seeing more rating. That jobs report really blew me away. I was surprised to see how relatively strong our economy is right now, even though anecdotally in my day to day, it doesn't feel that way. I mean, I can't count how many businesses I see with job openings being advertised on their front doors. I talk to lots of small business owners, and oftentimes they're having a very, very hard time filling these positions. So it made me think a little bit deeper, and I wanted to get a little bit more detail in regards to the methodology and how these employment figures are collected. As I was researching, I found that there's actually two different models in which the jobs or unemployment slash employment are reported. The first one is ADP, and ADP came out with a report of 106,000 jobs added over the month of January. However, the other model, which is from BLS, Bureau of Labor Statistics, said that there were 517,000 new jobs added. If you're confused, hold tight with me. We'll be able to bring some clarity to this soon. And to do that, I'd like to show you a quick clip from Jeb Smith. He's a realtor in Huntington Beach, and he works for Coldwell Banker, does a great job explaining this.
Until you realize the BLS, the Bureau of Labor Statistics, actually revised the way they calculate these numbers. So what's the bottom line? Well, there's actually two reports within the jobs report, and there's a fundamental difference between the two of them. The business survey is where the headline job number comes from, and it's based predominantly on modeling and estimation. The household survey, where the unemployment rate comes from, is derived by calling households to see if they are employed. The household survey has its own job creation component, and it showed that there were 894,000 new jobs created last month. But that's where the big adjustments to the data actually come in. The BLS made a normal adjustment to the population control data, which actually added 810,000 of those jobs. That actually puts the household data more in line with the ADP report of 106,000 jobs this week. Seasonal adjustments also had a big effect this time. So while job growth was strong, it's not necessarily as strong as the January report.
Show, it seems like we have a quite robust job environment and employment ratio, obviously. However, not everything is so upbeat. As you can see, this is an article from Yahoo. It says the latest job report was red hot, but ominous LinkedIn data tells a different story about the economy. And as you can see right here, LinkedIn also studied users' posts for signs that the labor market strength is waning, and recent data is not pretty. The number of posts mentioning the words layoff or retrenchment on LinkedIn soared 37.7% between December 26, 2022 and January 22nd, 2023, compared with the 4 weeks prior, and posts mentioning open to work increased by 18.5% over the same time. So, between the way that these employment statistics are calculated and retrieved, as well as the anecdotal experience that I've been having and many others who I talk to, and then this information that you see in this article from Yahoo regarding LinkedIn stats and what's being talked about on LinkedIn, doesn't necessarily make you feel super convinced that the jobs outlook is as good as they say. Regardless of whether we have the ultimate confidence in the unemployment figures, the reality is that rates did increase at the end of last week. And when we look at the factors that the Fed is considering in regards to what they will do with rate in the future, unemployment looks very low, and inflation increased by 0.5% over the last month. So I expect that we'll see a lot of the same of what we have been. There may be some little ups and downs, but generally rates are going to remain pretty darn high, and that will certainly affect our real estate market in regards to affordability and when and where people make housing decisions. So I hope that this was useful for you. As always, feel free to comment, to reach out to me, and you can also call me directly. My number is 303-888-4696. Love to chat with you, give you some more context, and get you into the real estate game when you're ready. Thanks.